This is Alder Friesen, CEO at Guardian Metal Resources, and you're watching Taking Stock.
Counting down to the close today is Monday, March 23rd, and you are watching Taking Stock. I'm Ashley Mastronardi. The market's in the green big time today after President Donald Trump posting on Truth Social that he is in, quote, productive talks with Iran. Here to make sense of it all is the Einstein of Wall Street, Peter Tuchman.
Hi.
Peter.
It's hard to make sense of that, but let's go with it.
Yeah, why do you think markets had such a strong reaction?
No, look, I think the market, people are heavily short all weekend long. There was nothing good coming out of the weekend, and this morning's tweet was a complete surprise. So, it caught people off guard. I mean, Iran negated the statement saying that we are not in talks, and that was what sort of the play was all day long. He came out of the woodworks and said that we have a deal going on with Iran. Obviously, the market was dying. We were oversold, short-term, way oversold. We were in correction territory in the Russell and the NASDAQ, so everyone was dying for a spot to buy it. When we had a little bit of good news, they went for it, plus a heavy short cover. All of that contributed to this massive rally. They're still not clear whether it's a real story or what, so that's why the market hedged its bet a little bit later on in the afternoon.
Why are markets so volatile when geopolitical tensions arise, and do we see them even out over time?
You know what, look, right now the main part of this is the oil. The contributing factor, that there's this different component to this. It's different than any other geopolitical situation like Ukraine and Russia. The oil is a massive contributing factor. It went from 65 to 120. That's going to play the market huge on the inflation side.
Solutions doing the honors for the close. Let's take a look at the green across the board. The S&P up more than 1%. The Dow up more than 1%. The New York Stock Exchange Composite also up more than 1%. And the Russell 2000 winning the race up more than 2%. Joining me now is NYSE market strategist Eric Criscolo. Eric, big day. Why are we seeing so much green across the board?
Yeah, once again, it's all about the headlines we're seeing from Iran. You saw maybe a potential way for the hostilities to maybe de-escalate a little bit, maybe an off-ramp. That's what the market is looking for. They want to see that this conflict does not go any further than it has to go. So, anything that stops this earlier rather than later is going to be taken as a positive for the market.
Also, when that post came out, we saw ICE Brent crude oil retreat more than 7.5%. As of this afternoon, it was under $100 a barrel. We haven't seen that number for a few weeks. Why are the markets so reactive to oil?
Well, oil, so much of the world's economy flows from or through oil. It's not just, what gets you around in your car, but it's also what, plastics are made out of. So much of the economy, the input prices get derived from oil. If the oil prices are going higher, that's just going to take everything else up higher as well. And we've already gone through so much inflation. There's a concern that another bout of inflation is just really going to be hard for the economy to handle globally.
What have we seen historically during geopolitical tensions? I understand a lot of my experts are saying we see short-term volatility, and then the markets even out. Do you think that is going to be true for this conflict in the Middle East?
Yeah, generally speaking, markets tend to kind of look past geopolitical events, whether they're wars, conflicts, etc. So we've seen that especially in the recent past. Markets have reacted initially. Sold off a little bit, but have been quick to recover. So that's kind of been how things have happened over the past 5 or 10 years. Everyone's kind of thinking this will still happen again. I shouldn't say everyone, but that's still kind of the consensus thinking. But as we said, as this Iran conflict keeps going longer, that's causing a problem for people kind of questioning that line of thinking.
And the Fed met last week. There was, of course, no March rate cut as expected. How do you think the conflict in the Middle East is going to affect Fed policy moving forward? Do you think that we're going to see a rate cut or perhaps a rate hike in 2026?
Yeah, well, that's what spooked everybody, was how hawkish everything seemed coming out of that meeting. And so everything got repriced. All the interest rates got repriced. Everything moved higher, not only in the U.S., but also globally. All the other central banks that met, they also kind of came out hawkishly and said, we're not going to let inflation get ahead of us. And so all the interest rates just went up. We saw that happen last week. This week, again, as if oil comes down, if the prices come down, that's going to help with kind of the inflation scare. That's going to help push yields back down. And when yields come down from the heights that they were at, that generally helps equities move higher.
Tomorrow we're going to be getting, to change topics a little bit, a flash PMI data. What is that? Why does it matter? And what are you expecting?
So the PMIs are, they're surveys basically. They're sent out to business leaders across the globe. And they basically are sent out to manufacturing leaders and service leaders, companies in those two areas. And they basically just ask questions like, based on or from last month, are things better or worse? And then, are prices higher or lower? Is your outlook better or worse? And they just basically take all those, yes and no's or higher and lowers, and then they come out with nice, easy ways to just kind of measure, are things improving or are things, not improving? And those PMIs they're looked at as almost leading indicators because they're survey based. They're kind of they were just collected recently, so they usually tend to kind of show what business leaders are thinking right now, the ones that are actually purchasing the products, that are making the business decisions of what to expand in. So that's why they're one of the more widely read indicators that we have.
All right, Eric Criscolo, market strategist for the New York Stock Exchange. Thank you so much for joining us on Taking Stock. Andrew's going to take your mic, and we are going to take a walk to the NYSE Notables. This is a very crowded floor for the closing bell. Of course, that Truth Social post that moved the markets, that came out at 7:23 a.m. Donald Trump posting that there were productive talks with Iran in pre-market trading. The Dow jumped 1,000 points. Of course, by the end of the day, it had jumped 800. ICE Brent crude oil retreating more than 7.5%. As of this afternoon, ICE Brent crude oil was trading under $100 a barrel. We haven't seen that number for a few weeks. We are at the NYSE Notables. The first notable that we are going to focus on is General Motors. It is up 4% to close the session. Investors are backing a $1 billion investment in Mexico. They're bringing production closer to the U.S. To protect their truck and SUV business from global disruptions and geopolitical tensions. GM has a strong cash flow and a growing software business, including $7.5 billion in deferred revenue from 13 million paying subscribers to OnStar. That, of course, is the in-vehicle subscription-based security system. Our next NYSE notable is Delta Airlines, up more than 2.5% today. This, of course, as oil prices drop sharply. There was much needed relief on fuel cost, of course, after the White House delayed strikes on Iranian infrastructure, sending ICE Brent crude oil lower and boosting expectations for airline markets. Well, recently I was at the ICR conference in Orlando, Florida, and I spoke to Steve Kislow. He is the CEO of Firebirds, and we talked about the rise of protein-centric meals and how his restaurant is catering to those demands. It's been called the Super Bowl of consumer conferences. ICR kicked off in Orlando this week with more than 3,000 attendees and 250 industry leaders. One of them is Steve Kislow. He is the CEO and president of Firebirds. It's a wood-fired grill with 69 locations across the country. Steve, welcome.
Hey, thanks for having me.
So what is Firebirds?
So Firebirds is a polished American grill. As you said, 69 locations, 22, soon to be 23 states. We operate in a space that allows you to get a more elevated experience than the usual suspects in casual dining, but yet, as far as a price point goes, it's just a couple dollars more or the same as the casual dining price point, but it's a fraction of what people pay in fine dining. Really, the point of differentiation for us is that wood-fired grill, as you said, and it really imparts. If you think about like the smell and the aroma of a campfire, it really it inspires emotions and it invokes your senses. And just like I think it really almost begins in the parking lot when you get out of your car and you can smell that wood fired grill. And then you come into the restaurant and see all those beautiful wood fired meats and seafood. And it's a pretty special experience for sure.
What is people's reaction to the wood firing preparation, and how does it differ from a traditional grill?
Yeah, that's a great question. I think about like the primitive form of cooking that cavemen and women had, thousands of years ago. It imparts this flavor profile that you really can't duplicate, and it's incredibly craveable. And all those different meats too, they just kind of soak up that really wonderful flavor and the char, from what that wood fire grill does for the food. So it's definitely experiential. All of our kitchens are open, so you can see the wood fire grill too. It kind of becomes part of a show. And then our bar is a big part of the product too. Not only are we seasonally doing cocktails with this really special cocktail culture that we have, but we impart parts of that fire too. So it's not just fresh juices; it's charred fresh juices. It's taking herbs and sort of, fire kissing those as well, so that these cocktails kind of take on part of who we are.
The restaurant's been on the scene for more than 20 years. What do you think keeps customers coming back? And do you have a loyal customer base?
We do. We do. It's called, and our fanatics are really, they're called the inner circle. And there's 2.5 million people, with over half of those being highly engaged. And I definitely think they keep coming back because, again, it's polished. People are spending their money. They just want a little bit better. And that's where the value proposition lies. You can get a more elevated experience, really great, wonderful, fresh ingredients and menu items. So I think people come back because of the consistency and what we've done for 25 years. And we've got a really successful track record along the way.
With like the protein craze and the interest in protein in the past few years, have you seen any growth since your meals are protein centric with a lot of meats and fishes?
Yeah, for sure. I mean, I think that center plate protein is what people are looking for. There's a health halo there because people are again, when you cook over that wood fired grill, you really get that the health halo that's involved in that. And also the price point is really a value as well because people see at the grocery store what's happened with protein, specifically in the beef basket. They know they can come to Firebirds and get a steak for almost what they're going to pay for in the grocery store. So we're definitely winning in that space. I guess sometimes it's better to be lucky than good. That's a space that we've played in for a really long time, and I think people are definitely coming back as it relates to the protein basket.
And with the new upside down food pyramid and the government is putting an emphasis on protein. Um, Tell me about where you're located, in the country.
Yeah, so 69 locations, 22 states. We're headquartered in Charlotte, North Carolina. So that's where we started. And there's definitely a good base of restaurants in the Southeast. But we also are through the Mid Atlantic as well. We're as far south as South Florida, as far north as Ohio, Pennsylvania. We've got a handful of restaurants peppered throughout the Midwest. And we have a pretty good concentration out in Arizona as well, in the Phoenix market. The beauty of that is that, the 22 states that we're in now, some of them only have 1, 2, or 3 restaurants. So really our growth strategy is kind of a grow where where we've already having proven success in some of those states. We're able to go in there and just open 1 or 2 more locations in those markets where we've already mitigated some of that risk.
All right, Steve Kislow, President and CEO of Firebirds. Thank you so much for joining us.
Thank you. Good to be here.
Joining us now is Adam Meinhardt, head of public policy at Chainlink Labs, who's been advocating for the crypto industry in the current legislative logjam surrounding the Clarity Act on Capitol Hill. Adam, welcome to Taking Stock.
Thank you so much for having me back on.
So I understand a tentative deal was reached on Friday. What is the latest from DC?
I think tentative might be an overstatement. Language was agreed to by the by senators Tom Tillis from North Carolina, Angela Alsobrooks from Maryland, and the White House on the yield issue. And currently, as we speak, that language is being discussed by the crypto industry participants as well as the banks. So I wouldn't say it was a agreement with those that are a party to it. I think it was an agreement on getting language done and on the table for folks to look at. So still hopeful that this gets through, but a lot more steps to happen.
What are those steps that need to happen in order for it to pass?
Yep. First and foremost, uh, the parties from the crypto industry have to look at it and see if the language that's being proposed by the Senate and the White House is sufficient for them to support it. And then conversely, the banks have to look at it as well and see if they're okay with it. So really, we need crypto industry and the banking industry to both look at it and agree that they're generally fine with it. Really, the policymakers on the Hill could go forward with it without industry support one way or the other. But what it really does is it risks not having the votes ultimately in committee if the industry advocates don't agree for it. So really getting sign off from the exchanges, from the banks is critical to getting a vote on this.
And if clarity is passed, how is it going to practically impact crypto?
Yep. Well, what's interesting about that is that last week we did see the SEC and CFTC issue uh, issue a promulgation about how crypto assets will be viewed from a securities and commodities perspective. So I think that sort of clarity is starting to come out of the regulators. But what the clarity bill on Capitol Hill does is put that sort of clarity in law, which makes it almost impossible to be overturned by a future administration. So what it really does is it really etches that sort of legal clarity about how you treat crypto assets into stone, really. Where the promulgations we've seen last week from the agencies, great to see, but those could be overturned much more easily by a new administration. So it really does give us the certainty that the industry and really consumers need to move forward.
All right, thank you, Adam Meinhardt, Head of Public Policy at Chainlink Labs, for joining us on Taking Stock.
Awesome. Thanks for having me.
We'll have more Taking Stock after this break.
Joining me to weigh in this morning is Christian Catalini, founder of MIT Crypto Economics Lab. Good morning, Christian. Thank you so much for joining me. So let's start out with this idea of counterfeit utility. Tell us what exactly it is and what investors should actually be paying attention to when it comes to tech.
Thank you and good morning. So I think we're all experiencing the rapid acceleration of capabilities with AI, especially over the last few months. Really starting in December, model capabilities have jumped ahead when it comes to coding and engineering tasks. So we're probably entering a period of fast takeoff. Where we will be able to do a lot more with the technology, but as a result, there's also a side effect of it, which is as the models become more capable, our capability to really monitor them, verify, and check their work that doesn't scale at the same speed. We're still bottlenecked by our biology, by our tools. And so that gap between what the models can do and what we can safely really certify is increasing. That can create accumulated risk and debt that may come due at a later date. I think we're seeing early traces of that as companies ship software and then they realize that some of that software has major vulnerabilities. A few days ago, we've seen a Chinese company release a private key that was really critical to their system in the wild. I think we'll see a lot more of this, and so companies need to pay a lot more attention to how they scale these agentic systems going forward.
Yeah, and Christian, many of us have heard the term SaaS, and you point out that we're moving from SaaS, software as a service, to liability as a service, meaning that companies will be valued on how well they handle risk and not just output. So practically speaking, what does a business leader need to change about their business model today in order to survive that?
Yeah, so the terrifying part of the change is, of course, that software is very easy to generate, and so many have been worried that traditional software as a service, a big part of it is really resting on the ability to ship better code in the wild that serves customers' needs, is not a moat anymore. Now that's not fully true. Things like distribution, network effects, the scale, and the understanding of your customer needs still really matter. But I would say in a world where agentic capabilities really scale, the critical dimension that every CEO needs to keep in mind is, are we scaling our verification capabilities at the same pace as our ability to really ship new products and services? That's what we call the liability as a service. You're not just selling software, you're often selling labor, right? So you can essentially use agentic workflows to recreate what usually would have taken maybe a number of employees to do. But you cannot do that if you also don't understand the potential risk of what you're shipping. And so the ability to underwrite that agentic code, that agentic output is becoming, I think, the core new moat, and investors should pay close attention to the companies that are investing in verification infrastructure versus the ones that are not.
You outline a dual threat on the talent side, so artificial intelligence is wiping out entry-level jobs, the junior analyst roles where people actually learn the ropes, so senior experts may be basically relying on coding their own replacements. But if you're running a major institution, how do you stop this collapse in human oversight?
So it's a tension, right? And we're seeing major restructuring recently. For example, Block, right, laid off 40% of their staff. I think we're going to see a lot more of that, especially in tech. Tech is the sector that is the closest to the transformation happening on the engineering side and the capabilities of these models. So I would expect many tech companies, and we're hearing rumors about Meta and many others being among the first ones to move on this. But it's going to be a broader phenomenon. I think people will realize that they can do more with less people. And probably the most challenging part of this is that if you're, fresh out of college and you're just starting your career, you're really at the level of capabilities often that the models are at. Now, of course, the models are getting better, so that level of capabilities keep rising and rising. And even very senior, experienced, staff people will have to really increase their capabilities and use the tools, use the models to lift themselves up the value chain. So for a CEO dealing with this transformation, I think it's important to realize that you need a constant pipeline of talent that will be able to, scale those models, that scale them safely and with the right verification capabilities. You will likely need the very top talent in your industry as the models get better, because that talent will have a lot more leverage than it did even in the past. And you'll have to fundamentally reshape also how you train people. Now, the good news is that I think of this, a lot of the same tooling that is creating disruption in the labor market, that is displacing things we used to do, is also creating the tooling that can get us back to the frontier. So learning will be much faster, mastery will be much faster. And so if we're going from a period where maybe your apprenticeship as a fresh out of college was that period where you would learn kind of the extreme edge cases of that profession, whether in law, medicine, finance, to essentially learning these at an accelerated rate through AI tools.
Okay, Christian, well, we will have to leave it there for today. Thank you so much for joining us as always, and thank you so much for sharing all of your insights and your perspective.
Thank you so much, Remy.
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. Today, we're going to be breaking down Stacks, the processor that flipped the script. Membership pricing instead of taking a percentage of every sale. Talk about a reinvention. Here's a proposition. Pay a flat monthly subscription, get 0% markup on interchange, and just cents per transaction, plus the software suite for invoices, links, hosted checkout, analytics, and more. For higher volume merchants, that math, it just hits a bit differently. So how does Stacks actually make money? Monthly subscriptions, tiered by annual processing volume, commonly published starting at $99, then $139, $199 plus, etc. Per transaction fees on top of raw interchange, basically 8 cents card present, 15 cents card not present type fees. And add-ons and services like ACH processing fees, chargeback protection, and terminal protection plans. Surcharging programs via CardX by Stacks, compliant tools where legal, often sold as a paid add-on. Hardware and implementation, terminals and setup for in-person commerce. So there's a lot of different ways that they can make some money. Let's do momentum check. Stacks membership model is now a mainstream alternative to flat rate processing for established small businesses, with publicly listed tiers and transparent cents per transaction pricing. Strategic moves like acquiring Payment Depot and CardX strengthened distribution and surcharging compliance, a practical moat for businesses managing rising card costs. So where is their moat exactly? It's a few things, right? It's about price transparency plus compliance plumbing primarily, though. If your cost model is built around a fixed subscription and legal-ready surcharging, switching back to opaque percentage markups feels expensive. Stack leans into that with tooling, next-day funding options, and an everything-in-one-place platform. Stacks monetizes predictability. Predictability for the win. Charge a membership, keep markup at 0, let merchants scale without surprise percentages, then win loyalty for the extras. It's Costco, but for card acceptance. That's the breakdown of Stacks, Have a business that you want us to feature, you want to understand how that company actually makes that cash, drop them in the comments below and maybe we'll feature them. In the meantime, back over to you.
You can catch NYSE live tomorrow morning at 9 a.m. I will be counting you down to the open, and FinTech TV's Remy Blair will be live from the Digital Asset Summit 2026 in New York tomorrow at the same time. Be sure to tune in. That's going to do it for Taking Stock. We will see you tomorrow.